Great. Welcome, everybody. We're going to give you a minute to trickle on in here. On this Thursday afternoon from Miami, Florida.
Bay Area, California.
Jim, where are you?
I'm right outside New York City and our Short Hills office in New Jersey today.
Right. So we're covering at least the United States. Right. We've got everybody coming on in. Just by way of housekeeping to let you know, we do have someone monitoring the chat. So as you have questions, we certainly would love this to be as interactive as possible. So as we're going through our slides and talking and discussing, if there's something you have a question on or you'd like us to dig in a little deeper, please go ahead and put that in the chat. So if you see my eyes glance away from this screen, it's because I'm looking at those questions so that I can incorporate them back in for us. So I'm going to get started, and we see that people are still coming in, but I'll go ahead and introduce myself, J.Thelander, founder, CEO of J.Thelander Consulting. We're super excited that you're all here today. We're going to talk about CVC compensation and a little bit some of the comparing and contrasting to venture. And I'm excited that we've got two of my great colleagues, Sue, a longtime colleague. I'll let you introduce yourself with what you've got going on now and a little bit why you're relevant here today.
Yeah, thank you, Jody. Jody and I go back a long time. A financial venture capitalist, and Jody was just starting her business and had this incredible idea of saying,
Sue, that's almost 30 years ago, just so you know.
It's been a long time, but it is a real pleasure to join you guys. I've been in the world of some type of investing since my venture capital days, and also as CEO of GE Ventures, which I started back in 2012. In addition to that, I had time as a public company CEO and enjoyed that very much, and also did a number of corporate operating roles over things, including chairman of the board of The Engine, which is very much involved in startup world and all.
CVC space, working with Jody, Sue, and many others through the ebbs and flows of that life cycle. Spend most of my time in that space and the M&A space that's adjacent to it, and some in the VC space itself, but more focused on CVCs and kind of the interaction between the funds, the formations, the portcos, and the.
Right. Well, I'm going to jump in with some data because that's always a healthy starting point for us to have our conversations. So by way of background, sort of how we get this data and who we are, that we are a namesake firm, me being the namesake, but also my daughter Morgan has been with the firm now for about 8 years. And the exciting thing that we brought to this industry, both to the private companies as well as venture capital firms and the CVC firms, is that the data is real time. So our platform is running 24/7. All of you who participate get access to a subset of the results for no charge. You can give the data and the subscription a trial for no cost, and the data is updated daily. So the information, as Sue knows, because we were just scrambling about 5 minutes ago to make sure we had the exact right data, was pulled. And we also have multiple surveys that this comes from, both investment firm compensation, investment firm salary increase. And when I say investment firm, I mean venture, private equity, hedge fund, family offices. And then we have a separate set of questions, as you can imagine, for CVCs, because the compensation is a little bit different. So here's of the most recent data that we pulled down, that venture capital is 44%, and you can see CVC healthy at 17%, and then the different areas of funds that we are surveying. And the nice thing is on our platform, you can custom run reports so that you can compare and
know this, the purpose that we actually
unit operation headquartered, and what's the primary location within the United States. And this comes up all the time, like, are there locations where there's a premium for money? And it really just depends. There's no one consistent answer. And you can see that these CVCs are located globally and within the United States, covering the country. And here is within Europe. Europe's become a big area for us, both on the private company side to have the UK and then all of Europe. And here is Western Europe. You can see also 74%. And now we're able to really look at data between the United States and Europe, which is definitely a question that comes up. Okay, this is what we were talking about here is the list of investment firm positions, right? So you can see that there are all the typical, managing general partner down through senior associate, and then all the operating roles, the chief roles, and then the VP, manager, and many of these roles now have taken a page out of the playbook from the corporates, where there's quite a bit of portfolio services and all of these folks' portfolio operations. And here's the list goes on. It's grown really doubled since the time that I started running these surveys. And then here's the list of investment firm CVC positions. And so you can see that these roles have expanded as well. And Sue, that's what you were talking a little bit about, are these portfolio development, corporate venture. And so those people, explain, from your experience, and also Jim, in terms of like a CVC starting out, how do these job titles really impact what's going on?
Oh, first and foremost, you've got to get your investors. And that's what I focused on when I was starting GE Ventures, to get the best in class venture capitalists who had actually been in the venture capital ecosystem, had been investing as investors in the venture capital ecosystem into GE Ventures. However, I would say in order to have a really successful CVC, you have to complement it with internal folks who really know corporate systems. So I had a CFO that had to come in. I had a general counsel that had to come in, and they were all coming in from the corporate parent. They know the systems that exist within the corporate parent. And then we built out to make sure that we could service both the business units and the portfolio companies, someone who was dedicated, and then we did it for each business unit, to those services overall. And I think that's what a lot of the investment firms, the financial investment firms, institutional VCs have actually done a lot of over time, as you listed with all those various titles.
Yeah, trying to add the services for the portfolio company services, even though they don't have to go between the parent company, the same thing as a CVC, but those roles to service the portfolio companies, obviously very important. And Jim, give us your angle on it. I mean, you're seeing this from starting CVCs, and what's the difference, how this is really evolved.
Yeah, it's become even more critical today and will become even more critical tomorrow, frankly. I'll give you two examples why, one of which was this morning. We were working with a large CVC that you all would know the name of, and there was a very kind of interesting international question that we needed to kind of consider. And the only way we'd be able to do that quickly is to know exactly where to go within, the larger sort of corporate, to drill down on a very specific question. If we didn't have that access, if we didn't have that know-how, we'd still be sitting here trying to figure out what to do. And, as the world becomes more attuned to FBI filings, merger control filings, regulatory world as we see it today, to me, that's only going to increase the need for that synergy between the CVC and the parent.
Yeah. All right, I'm going to go back to sharing my screen here. All of what you're talking about, we are publishing now a digest each month for both private companies, investment firms, and also CVCs, that really tries to be very topic specific on the timely matter. So incorporating the data and also adding a layer of analysis on it, because there's a lot of data, but we see that because the markets are very they've fluctuated, the valuations for companies have been changing. There's a lot of money going from corporates into portfolio companies, and it's that we try and make sure that we stay abreast of that. And all of that is, we offer that for no charge. So of course, Morgan will add into the chat if you want to be able to sign up for those. Let's get down to some of the basics for corporate venture firms and what the different compensation levers are. And that includes base pay. This is on the cash compensation side. And then what we survey is a current bonus, which means that bonus was received, and then a target bonus, which is out on the horizon. And we report these both as a dollar amount as well as a percentage of base pay. And then we also, so that gets you to the total cash. And the total cash can be a combination of base pay and an actual bonus, or it's just base pay because not everybody has a bonus program. So that's why the numbers are not a straight addition. We get this all the time. I just had a call with a client in Japan last night going over this, why the things were not actually lining up the bucket of base pay plus bonus equal total cash. And then the other incentives, this is sort of, I know everybody's hot button. We're prepared to spend some time on this. The other incentives, right? Corporate stocks, so shares in the parent company, and then the incentives inside of a corporation that might be a CVC unit that are attractive, the shadow, phantom, and synthetic carry, and then also a true carried interest. So without further ado, let's look a little bit at this, and we'll get into what the definitions are and so on. We thought it'd be, everyone likes to see a little bit of data. So here is the CVC unit leader. And so that's the number one job. That was the job like Sue was in, for example. And this is showing you I gave all the percentiles. I think it's really important. We actually also show the minimum too, but I gave you the 25th median, 75th percentile, and max. And also just as a legal, if you go ahead and take a picture of this, that's great. Please don't put it on the internet because it is copyrighted. So we gave you the sample sizes as well, the base pay, the current bonus, target bonus, and total cash. So the big reason why the base pay and the total and the current bonus don't equal total cash, as you can see, it's not the same sample size. But you also see the range here, right? From the 25th to the median to the 75th to the maximum, quite a bit of range. So Sue, you see that obviously, having had your experience in a very high profile CVC unit, and also knowing that there are many CVCs that are just starting out. This could be in Europe as well. There's not all CVC unit leader compensation is created equal.
And that is the truth. What I will say is it's dependent where you're recruited from. And so you're trying to match, and it depends how quickly the corporation really wants to set up their CVC unit and what their actual end goals are with the CVC unit. And it depends on the experience level. And I think everybody knows that. It's very similar to other positions, but it has become more competitive because of the rise in CVC units that you've probably seen, the growth in CVC units, even in 2023, where fundraising was very, very hard externally and capital was just not as easily had out there. Things were a little bit quieter in the 2022-2023 timeframe, but yet 65 new CVC units were actually formed. And that is because corporates really want to do it. So the recruiting was still pretty active. I mean, I got a number of calls still for some of them that were out there. So it just gives you a little bit of a sense that it really depends where you're going to come in.
And also what the mandate is for, and Jim, if you can add a little color on this, it depends on what the mandate of the CVC unit leader is, or the CVC is as it relates to the parent company, right? Because some of these don't have any financial return. They don't have any, responsibility for bringing in revenue. And they only are going for technology transfer. And depending on that mandate really depends on, and the structure of the firm depends on the compensation.
Yeah, I couldn't agree more. And Sue's 100% correct, right? We've been in a bit of a choppy time in terms of how the investments have played out and what CVCs are actually spending their money on, a lot of bolstering existing investments and things along those lines. But at the same time, you're seeing that increase in overall number. I think there's two reasons for it. One, I think many companies are realizing that they need to be in this space. Do they need to have the size of what Sue built? Maybe not, but they certainly can't not be in the space. And secondly, I think they've really become accustomed to investing as syndicates. They sort of will come together in meaningful ways, and they can kind of find ways to work together within antitrust constraints, et cetera. And then I think to your point, right, what is their mandate? How big is their fund? What are their financial and strategic returns? Those are going to be guiding posts in terms of who you hire and what experience you need them to have.
Well, that's a question that just came in, right? So
Oh,
I'm going to
okay.
share my screen. I'm going to move into, I'm going to jump around a little bit. So I'm going to stop sharing this. We had a question about basically how does CVC compare to VC compensation? And also, are the support groups and technology roles at CVCs, meaning like a product manager or programmer, typically eligible for carry and synthetic carry plans? And that answer is no. And also that's a no as it relates to the question, how does CVC and VC compensation compare? Most VC firms do not have carried interest all the way, not all VCs have carried interest all the way down through the organization. Some do, the younger funds do, the emerging funds, but a lot of the traditional funds do not have their carried interest going all the way down the organization. But let's look here at a couple of things to get into this. We knew this would be the crux of the conversation. So the CVC unit structure impacts compensation and the additional incentives. So, and we can go back, by the way, what I left behind was some of just the basic compensation numbers and how that has changed. But I think that, you seem like a very sophisticated crowd out there. So the actual numbers are probably less meaningful than really what's going on. So the structure of the investment firm, we survey this to ask, and maybe Jim, you could talk us through this, like the different categories of this, if whether you're on a deal by case basis, or, maybe you could explain.
Sure. And is this slide, is this from VC perspective or CVC?
Only CVC. This is the CVC. Everything here is CVC. It's a great question. I myself had to have my team go back and say if something was VC versus CVC, because it gets confusing.
No problem. Just want to make sure I'm answering the question in the right light. So yeah, I mean, as we've been talking about through several of these seminars, there's lots of different ways that people structure their funds and their investments in terms of where the money comes from and whether or not it's on balance sheet or off balance sheet, or whether or not it has to be sponsored by a unit within the the greater kind of parent company. So when we talk about off balance sheet, we're talking really about an entity that's formed specifically as a standalone entity, either with dollars that are allocated to it or evergreen dollars that come off of a year by year kind of analysis and basis. And then you can morph from there into where there's no defined amount of money necessarily that a CVC unit is provided with, but if opportunities arise, they go and speak with an aspect of the business or a division of the business, or in some cases a legal entity of the business, and that entity acts as sort of a sponsor of that investment, and it becomes part of sort of their balance sheet and such. And I kind of just refer to that as a sponsor, right? There's many funds set up sort of in that way, and then there's lots of hybrids in between that. And we've even seen funds now where you have one CVC unit with 3 or 4 different types of investment strategies depending on the division they're working with. So I think it's ever changing is the
and then of course the true separate entities. So these questions are, I think that's actually a good point. We should add that in, like if you have multiple sponsors, financial sponsors with inside a company, do you have different structures of those funds? So we're going to add that into the survey. That's the nice thing about us being in charge and having the survey on our own IP, is that we can add that question in tomorrow. So thank you. But we do see now, and this is where the analysis has been great, is the structure of the investment fund does, the more independent, it does impact the compensation. So we can see here that the not off balance sheet or separate legal entity, right? The not off balance sheet or separate legal entity year over year. We've been doing this now enough years that we have the data to look 21, 22, 23, 24, which is great. And you can see that the corporate stock alone, and Jim, we know there are different, what corporate stock could be multiple things, options, performance awards, RSUs, and then or some form of carried interest, or a shadow phantom synthetic carry, or the corporate stock and some form of carry, so a combination. Sue, thoughts on this? I mean, I know we talked about that, everybody always wants carried interest or some version of it.
I think, Jim, and you put it, sort of set the framework. I think it really depends on what the structure is, what your legal entity is, in order to be able to set up your compensation programs appropriately. When I first came in, I tried to get it off balance sheet. It was going to be on balance sheet. Okay. Then I said, well, let's try to do synthetic or phantom stock of some
Right.
type, because there was no way I was going to be able to match what is outside in terms of carry, particularly for the investors who had been, very active investors and were already receiving carry, who were coming into the corporation. So what I found, and I'll just
And
share
let's
this
face
with
it,
you guys.
Yeah, go ahead. I'm gonna let you
No,
finish.
please.
Well, you know the difference, because when you were at More David Howe and when you were in True Venture, you know that you had to raise your capital. Fundraising was huge. And inside, and you also had to contribute capital for your carried interest.
Correct.
And that's a significant difference than inside of a corporate, where you're not really raising the fund. Although, Jim, you might beg to argue there's a slight difference depending on how complicated it is, but you're not going to multiple LPs. You're going to the parent company as your single LP. And in most cases, you're not raising the fund, you're not contributing capital. So the risk reward model, even if you do have carry, would be adjusted.
And I would say the following, I think that was very well said, Jody. And you also have to find out, if you're on balance sheet, you will find out very, very quickly that the structures and the culture of the corporation are really going to dictate a tremendous amount how you set up your actual compensation structures. Over time, when I first started, I couldn't get all the things I wanted to get for the team. Over time, I was able to get one thing, even though we were still on balance sheet, and that was to be able to participate with portfolio equity in those companies that we created with incubators. Okay, so that was, and we had all sorts of criteria.
Let's take a pause on that, and maybe Jim, you could talk about what you're seeing with this. So there are multiple ways to skin this cat, right? You may not have a true carry, but you could get equity from on a portfolio company by a portfolio company basis as part of your compensation.
Yeah, no, absolutely. And Sue, I'll just be brief and then let you get back to your thought there. But there's a variety of different ways that CVCs compensate. Obviously, we had that slide up that showed sort of what I would say is probably pretty typical in terms of a vast majority. The one right after that. Yeah, thank you. On my left-hand side here in terms of corporate stock. And look, I mean, I think the trade-off is pretty obvious in terms of what the corporate stock is intended to do versus a form of carried interest or some kind of synthetic. In many conversations we have with folks when they're forming their fund is, what is the goal of the fund, right? If the goal of the fund is to mirror what the corporate is doing, right, to create value within the corporate, then the corporates will often say, of course, you should participate and we should treat you the same as we are because our goal is the same, right? So your ebb and flow of the company is the same. It's a really interesting conversation when you talk to CVCs whose determined goal is to be outside the core, right? To be looking at things that aren't core to the corporate's business. And there is where at least I see the conversation of, well, wait a second. You're telling me I'm supposed to do something that is non-core based, so why am I being rewarded or penalized depending on the
And that's when they call us and say we need help consulting.
That's
the launch point of every conversation where people call us from the CVC and say, listen, we need help to explain to the parent company, the comp people and the HR people, and to the higher ups that we need a different comp structure because we have a different goal.
Yeah, and look, I joke, but I shouldn't in this respect. It's a very complicated conversation to have because in many cases when you're looking at even the way, and Sue can speak to this much more intelligently than I can, but when you think about titles, in large corporates, those titles often equal to a comp structure and it's defined. And to kind of deviate from that creates massive confusion and a lot of discontent in some cases because someone will say, well, wait a second, if this carried interest actually succeeds, Jim could be making demonstrably more money than Sue.
Well, that's where there has to be a cap on the amount payable. We're going to get into this. I'm going to move into the next slide because you're touching on everything. And I know the audience likes to see the data on this. And I think the point of this, though, is how holistic all of this is, right? And this is where, as you're starting a corporate job, a CVC job, you got to know to ask these questions. And also once you're in, to be able to navigate this. And also, as you're recruiting people, because all of this is tied together and it's sooner or later, it comes up every single time. So here's the not off balance sheet, right? So the next page that I have is the off balance sheet. Or separate legal entity year over year. And you can see that these numbers are much higher for some form of carry only or the carried interest or shadow phantom carry. these numbers have gone up. And that independence is very much part of the CVC's unit ability to have a separate comp structure. And the corporate stock in some form carry mix. There's still a lot of corporate stock. And Sue, you and I talked about this the other day. I mean, corporate stock is also very valuable because it is typically paid out every year, right? There's a vesting time for corporate stock, which is much lower than the vesting time for carried interest. We're seeing in our carried interest vesting times that the 10-year plus is on the uptick. That's the area of largest growth. Jim, you're shaking your head. Yes,
Well,
you're
yeah, and
seeing
I
this.
think I'll just say it quickly, right? I think that's because the hold times, you know, for better or for worse, right, are increasing.
Right.
There's a direct correlation between exit and ability to pay those carries. So, you know,
Right. For
And
all
let's be clear, like you were saying, Jody, the vesting in corporate stock is pretty defined. They're typically, 3-year vesting periods.
Yeah.
You get annual vesting, and you've got, assuming you perform well, most corporations will continue to give you annual grants. So it gets layered. So don't discount the corporate stock. There is no doubt if, in fact, you get winners and you have carry,
right,
and you can actually exceed the actual threshold of where your fund is, now you get into the big money. And so the upside could be much higher. But, one would argue if you were with NVIDIA and you get corporate stock, that's a winner.
Yeah, and
Well,
not
that's
to get too legalistic and not to provide legal advice, because I can't do that on this telephone call here or this video call, but there are certainly tax considerations to be had in terms of stock basis and cash basis and things that we all, deal with in our daily lives. So there's many considerations to it, in terms of what's better or worse, or the combination of them.
Right. So that's where the questions come back to what people were asking us about: how does CVC compare to VC? So the cash compensation can be comparable. It also, at the top levels for CVCs, can be a little bit lower, but that is also because it is predicated on the fact that they are not making a capital contribution for their carried interest. The other piece to know is that for those of you that are just getting corporate stock, that is a very valuable asset because it is a consistent payout. The carried interest vesting times are now increasing at the 10%, 10-year time, because it's taking longer to liquidity. And in addition to that, the cash compensation is not going up each year to really, offset it. And in many cases, there are folks who have not seen a carried interest distribution. So this is why it is not an exact apples to apples. And it's very important to understand this. I'm going to keep moving through some data so we have this. So this is the senior investment professionals. This is the next level down from the CVC unit leaders. It's number 2 job. So are you eligible for additional incentives beyond cash bonus by the structure? So I think we're getting our point across that the off-balance sheet or separate legal entity has a little bit more typically of some additional incentives beyond the cash bonus. And here is the senior investment professional median total cash year over year by the unit structure. And you can see this is off balance sheet or separate legal entity versus not off balance sheet. And there are quite a bit of parallels here. So I'm going to move into here we look at I want to show the cash value of corporate stock, because, and so you can speak to this as well, because you saw some of this. So just to prep you for what's here, this is the senior investment professional median cash value of corporate shares. And this is the not off balance sheet or separate legal entity. So that's probably, they got more corporate stock, right? And then here it is with the 75th percentiles. And you can see it's pretty substantial,
and I
right?
can say, depending on your level, and this is, you're saying the second, but even within that second level, depending on where you fall within the banding of a corporation, you could see higher than this. So, and there are different things. I will also say one other thing about corporate compensation associated to this. There are different levels of programs. There's the annual equity grant, and then there's the long-term equity grants, depending on the level you're at. And those can vest in 3-year sort of timeframes and are all performance-based. That's another layer on
Jim,
top
you
of that.
explain this to us a little more. I think this is very important, because it oftentimes comes up in corporates that they want a long-term incentive, and they don't. So there can be corporate stock that is both short-term and long-term.
Well, yeah, and it's not so much the stock; it's just the way it's awarded and the program pursuant to which it's awarded. And a lot of times it's used for various different reasons. One is retention for the obvious reasons, right? I mean, we live in a strange world right now in terms of where and how you can use other legal levers to create retention. So would not surprise me to see the LTIP concept increase in its use as other elements of retention are not as available specifically to employees or employers trying to enforce against employees.
And so you mentioned in terms of jobs as well. I mean, even since we've started this, we've now on the CVC side have separated someone being seniors, we've associates, we've already now have a junior and a senior. Like we continue because it's very much evolving, and the getting the job title right really does impact your compensation. And
Very much
even more so, yeah, right. And also we look at this, one thing that we fashioned this after is very traditional, right? My background came from a Fortune 500, and when I got my master's in human resources and learned compensation, funny enough, I was on a call with a client this morning who was talking about they used to have the Hay point system, and I remember it, right, adhering to that. And the CVC comp data is very friendly. It takes what is a very complicated area and tries to really simplify it, because my background, having come from a corporation, is such that despite we're only covering private markets here, that we do understand how to translate. And that's why these percentiles, having the minimum and the median and the average and so on, it is somewhat reasonable for a corporate HR person to understand it, because it's not completely. What's challenging is the shadow phantom carry or the carried interest, because that's just extremely confusing. But other than that, the data and the way it's set up, but getting the job title is right. So let's move into a little bit of the shadow phantom synthetic carry. What does this mean? Let's really try and break it down. So how is it calculated? Jim, you want to talk us through this, and Sue?
I was just going to say, how is it calculated? And it depends, right? But Jim, go ahead.
Yeah, no, I mean, I think that's exactly right. And maybe we should just start with overall kind of what is shadow phantom synthetic carry calculator, or what do those terms even just mean, for just 2 quick minutes, right? So you have a traditional carried interest. We know what that sort of means. To state the obvious, shadow, phantom, and synthetic are alternative ways to mirror those direct sort of investment type terminology into something that mirrors or provides a cash sort of base as to how you would basically take a pool of money as though it was part of a carried interest and use it to return. So, we're living in a world where, let's just go left to right? Change in fair market value of portfolio only. So basically what we're talking about is mark to market at a particular time and how it ebbs and flows, ups and downs. That has been very, very challenging, at least from what I'm seeing over the last couple of years, because you had wildly high valuations that have certainly come down. And now we're kind of in this interim period. It's not surprising to see 66% of return from portfolio exits, right? That's the traditional way you look at it. You bought something, you sold it. What did you make? And how do you kind of equate that?
And what's the hurdle rate? Like what has to be recovered? So that's what a hurdle rate means. What has to be recovered before you can start the clock ticking on what you're going to get?
Yeah, the way I sort of explain this to folks when I first talk to them about it is take it outside of it and talk about just, you bought a house, right? What was your mortgage and what do you have to carry before you make money? I mean, it's the same kind of concept. And then, 9% both, that can often get pretty complicated and very specific.
That's probably why it's probably 9%, right?
Exactly. And then, I'm not exactly sure what fits into the other category, but again, not surprising to see that the vast majority is the prior to, and again, it's very, very customary to see the portfolio exits as the base rate. Now, again, I would say as that elongates in terms of time of hold, you might see these numbers fluctuate in a bit of a different way.
As an aside, I'm going to just take this off for a second, because we've had a lot of discussion with investors as well as portfolio companies on the fact that there have been some down rounds and valuations, fluctuation. We're co-branded with PitchBook on our investment firm survey, and that they also distribute this to PitchBook clients and to the Get It Out. And so we've been involved as they're publishing what the valuations are. We get to say how that impacts. And really what's happening is that it is impacting the equity because you've got to refresh grants to these executives and to the teams, the key employees, if there has been a down round, because you need them to be incentivized and to stay. And that's obviously impacting the option pool, which is then further impacting the investors because that additional equity has got to come from somewhere.
Yeah, the only thing I would add one thing to that too is just something we're seeing. It's slightly off topic, but I'll try to bring it back quickly.
Yeah.
You know, the idea that the way CVCs and the way VCs are approaching sort of those down rounds or flat rounds, in many cases, is vastly different, right? And the CVCs are looking at it from the standpoint of what was their real goal? Their goal was financial return, that's obvious. But if it was something different than that, and they have a VC partner, which many of them do, there's a lot of conversation and difficult conversation about, are we going to invest? Are we going to, and in many cases, you know, the CVCs are prepared to, and maybe VCs are not.
That's such a great point. I mean, and this is why, though, the essence of it, and I just love your expertise, Jim. Your mind is so sharp on this in a way that really is exactly the crux of what we're going after here, is to make sure it's not just about the data, all this great data we have. You got to know how to use it. And it's a group effort, right? You've got to have great legal counsel. You've got to have outside board members like Sue, who really can advise you on all of this, because the market's changing so fast, and you may be co-invested with people that have a different you know, priorities than you do. And you really have to understand that that's also why the comp is different, because you have a little more range in terms of the CVCs, and sometimes not having that financial return can help you in terms of where you are with the company. I mean, Sue, you've experienced this.
You have two bosses as a CVC. You really do. First and foremost, you've got your corporate. But if you're going to subsist in the ecosystem of VC, and you got to get into the best syndicates and the best deals, you better act like a VC, which is totally financially motivated. But guess what? You have strategic goals. You're supposed to help the business units identify new technologies. And I know everybody in the audience knows exactly what I'm talking about. Therefore, when you're creating these types of incentives, what are you incenting for? And how do you make sure that those incentives are actually going to serve the corporation where you're responsible to shareholders? But at the same time, you have to be the most attractive CVCs for your VC syndicate.
Right.
So it is misaligned incentives to a certain extent, and you've got to manage that to the best of your capabilities.
Not so easy, right? Okay, so here's how is the shadow phantom synthetic carry? Just to see, I think it's the first time we've sort of entered into the assets under management. So here's the less than 250 million investment capital under management, and then the 250 million plus. So the larger the fund, you typically, they have more of a percentage of return from the portfolio exits. And here is how is it paid? And, Jim, you may want to chime in here to talk a little bit about, I know you're not giving tax advice, but cash that's taxed at ordinary income. And
that's the biggest distinction, right? I mean, just to state the obvious, we all see this in our daily lives. Cash is cash, and cash gets taxed a certain way. When you start getting into RSUs, or restricted stock units, stock options, and different types of stock options, and then portfolio company equity, that obviously ranges from ordinary income to long and short-term capital gains, and then also just offsets in terms of what other potential tax scenarios are available, QSB, things of that sort on the portfolio company equity.
Right.
But
and also for a VC, so it may take a much longer time, but that is always going to be, that's come up obviously in front of many committees inside of the government to change this. But right now, carried interest is paid, and it is the capital gains.
It's structured the right way, yes.
Yeah, right. I guess, right. That's where we need you again. Okay, vesting time for the shadow phantom synthetic carry. Much different than, so the 10-year plus is the smaller end here, but this is the 3, 4, 5 years. So right now, have you seen a shift in this, Jim, in terms of your practice and where these CVCs are headed?
Yeah, not really. And I think, again, hold times will have some impact on it, but a lot of it depends on, to Sue's point earlier, who is getting the carried interest, right? If you're talking about somebody at a very senior level, the idea that they have to wait 10 years to get it. Well, how senior could they be, right? I mean, obviously with age, hopefully comes some level of wisdom. So there has to be a balance because, people aren't going to necessarily just sign up for a 10-year situation. And on top of that, when you look at the length of years that many CVCs are in business, I mean, the truth of the matter is sometimes 10 years is just too long for that program, right? Different strategies, different times. So not really surprising to see the 3 to 4 and 5 years being the vast majority.
And then can I just add to that, Jim,
Yes, yeah.
because the other point of it is in corporations, people rotate positions. They do not stay in situ in a specific job for as long as a VC might stay in a VC firm, right?
Yeah.
So that's another point of view that people take with them because, well, wait a minute, how am I going to influence the performance of the portfolio if in fact I'm going to be in another role, if I go into corporate development or if I go into some other type of role
And it's
within the
not
corporation.
structured the
So just
same
another
for that
consideration.
reason, right? I'm going to move to this slide and maybe Jim, you can talk through this as well as how is the SCI bonus pool calculated, right? And this just shows you the different ways fund-based and they, where there's a corporate hurdle rate, or if there's fund-based paid when there's allocated investment funds are returned. So there are many different ways here, right? And then the highest percentage is a combination of fund-based and deal-based. So,
Right. Yeah. And maybe we can just try
you talk us through. I think we should slow it.
break
We
that
always
up
go
into-
so fast and people want to know.
Yeah, no, we'll try to be succinct here. But so fund-based as opposed to deal-based, just sort of to state something of the obvious, right? Fund-based meaning the totality of the fund, the overall AUM. Deal-based, literally, Jim works on these deals and Jim's compensated on these deals. It's at its very simplistic level. That's sort of the way that that people look at it. Not surprising to see 42% on the left-hand side there of fund-based, and then the combination of fund-based and deal-based, because the deal-based ideas or concepts a little bit newer, at least in my experience, than the traditional models of fund-based, because fund-based was a VC model that has been around for a very long time. But as you're seeing sort of an influx, even on the VC side, of sponsorless funds or deal-by-deal fundraising efforts, you're starting to see the ability of these types of bonus structures to come into play. And just the simple example you can use, and this is probably more true in the PE side than the VC side, but there's lots of basically private equity funds that go and shop a deal, and so they will compensate that group by that deal.
But Sue, you were even saying that as it relates to getting carried and getting equity from a portfolio company. I mean, what we're seeing is a part of this just because it's a whole fund to return is taking so long. The vesting times are taking so long, and you've got to give some capital distribution. And most VCs, some VCs offer a loan, of course, which the partners are like, what am I going to do with a loan? People want to see liquidity.
I can't tell you, and people want to see that their efforts are being compensated not only on the corporate side, but that they can influence the portfolio side of things.
Right.
And typically they do work on specific deals. That's why you're seeing more and more deal-related type of incentives than you have seen in the past, because of all of the dynamics that Jim described previously that's going on. So yeah, we did get to a point when we were creating our own companies in our incubator or our studio, if you'd like. We did then, we were able to get, and this took a lot of convincing, equity in those specific companies. And again, remember that as far as the corporation's lens looked at this, there's a dual conflict. You are personally conflicted potentially against what you're doing for the corporation if in fact you're going to do the portfolio. If the company changes strategy and we no longer want to be invested in this type of company, then what happens? You still have equity in that company. So these are some of the dynamics that you have to overcome. And please understand that this is why it's not as easy to get as much as we'd like to be able to get in the corporate VC world to mimic everything.
But with that is more stability. So Jim, in looking at this, this is where we talk about the larger assets under management. And that obviously would be a CVC that's been around longer, probably co-syndicating with larger VCs or with more prominent VCs. And so the compensation is showing the fund-based or a combination fund-based and less deal-based, because it is more being, looked at like a traditional fund, and it probably has the same mandates.
Right. And I think the other thing is a lot of times you're seeing CVCs now, well, not even now, I mean, historically, and Sue, correct me if you disagree with this, but you're seeing a lot of CVCs that will have multiple, let me just call them cylinders, within their units, right? And a lot of times those goals
Right.
are different, their investment strategies are different, their returns are different. So somebody's saying, well, I don't want to be compensated on what, Jim's doing in his cylinder because the market.
Right. Well, it's like a different vintage of a
That's
venture
right.
fund. So there are
That's
more and
right.
more parallels coming.
Yeah, for sure. And again, to your point, it's not surprising to see the green,
Yeah.
the green higher end funds with those.
Yeah. Here, talk this one as well. So I wanted to make sure I see what, because we're getting down to some really good stuff here. So what funder expenses are included in this, incentive, this pool
Yeah, and Sue, I'll be
calculation?
curious to hear your take on it because I always kind of marvel at some of these things. So, in terms of a CVC and the way it's set up, off balance sheet, on balance sheet being probably the place you start, is what expenses are being allocated to the fund, or a portion of those expenses being allocated to the fund, basically on the resources they're using from the parent company, right?
Parent company.
Tax, accounting, HR, you name it, right? Whatever those things are. So it's not necessarily all that difficult, at least in my mind, to identify what you're using, because you kind of know that, but what portion, how you're allocated those expenses, well, that's a bit of an art in my experience. But it's critical. And to Sue's point earlier, in terms of
Right.
setting your agendas and your goals for your employees, helping them to understand how their profit and their margin is being calculated is critical. It's like any other business, right? You got to understand how and why.
Right.
There's a lot here, but Sue, I'll be quiet for a minute and see if you have anything to add on the.
No, I think you've said it. And I will say allocation is always the argument. Let's
Right.
be clear. It doesn't matter which business you're in, allocation of how much of corporate am I using, how much am I not. We were lucky. We were ring fenced. So we had dedicated resources to us. And for the most part, we didn't have to go and get allocations across. Now, that said, there was talk of moving into that. We never got there because there were resources we were using from the business user. There were resources we were using from Treasury. There were resources that we were, and so you always are going to get into this allocation game. And I think you really have to work towards making sure you minimize as much as possible getting charged that allocation.
So why don't you
unit.
take the lead on this next one about how are the individual SCI bonus pool allocations determined, right? And this is the individual. So this is, I think, very relevant to the experience that you've had, the team role, the role in the individual deal. So a set percentage related to,
Yeah, and I'll do this also from a compensation committee role that I play on several boards.
Right.
So here's more and more what's happening is it's going towards performance-based goals all the time. And number two, for the most part, it's back to what Jim was saying before, depending on how you're structured. If you are fund structures, it's going to be team. And the whole team has to meet certain sort of expectations in order to get the kind of performance units that you want to be able to get. That said, there is, depending on your level, and again, this depends on the company, but depending on your level, you get different sort of banding. 70% towards team, 30% individual. 60% towards team, 40% individual. And again, depending on your level and depending on what kind of fund structure or combined fund structure and how you're measured accordingly. But you're always trying to match the incentives to make sure that you are incenting appropriately to the fund structure and to the goals and actual behaviors that you're trying to achieve overall.
I'm just going to thing to that quickly, if I could. So I think it's really becomes critical where you have sort of that fund that's got multiple cylinders or multiple silos in terms of how they're investing. And if one is considerably more risky than the others, right? Like you're investing in something that is really early stage and has a long way to go. Those types of things also play into kind of that mix in our experience in terms of how Sue and her, senior level team gets compensated and how they then look at it down the line. If I'm asking somebody to do something that is a more difficult return, well, of course, then I've got to think about how to compensate that person.
Other incentives. Yeah. I'm gonna move, so we do know that there is a cap on the amount payable in most cases,
Yes.
right? And that it is, I'm looking here at how it's calculated. I'm gonna show a couple things and I'm gonna wind up because we're getting short on time. It's like we need an entire other webinar to be able to address these other issues. But how is the cap calculated? I know this often comes up. And so it's a defined cash limit, or it's not to exceed. This is the typical compensation, right? You can't have somebody in the CVC unit making more money than some other people on the proxy information. So, right?
Well, yeah, and it's, I mean, believe it or not, that actually is a real issue in terms of,
Right.
it would be very unusual to see in a publicly traded company, somebody in the top five who's not in the C-suite of the parent company, the publicly traded entity, be on there. But you could certainly see it happen if something happened in a great way. We see for the most
Right.
part, you know, that the slide that was just up there, that the blue situation in terms of ultimately people are looking at what is the maximum amount of cash that I can pay out where there's really very little questions I have to ask, and it stays within, generally speaking, our band of
Right.
titles and remuneration for those titles. And that's the
Yeah.
overwhelming way we see it done.
I'm going to wind up with a few slides here. We have a lot we could have gone into. We're going to have another webinar just on the carried interest, like a true, what the 80-20 split is and how that gets, shaken down a little bit into a corporate, as well as the corporate stock distribution. But I'm going to wind up where one of the first questions started. And where does it really become competitive across CVC and VC? And it's really more at these levels, at the more junior levels, at the senior associate levels, where the long-term incentives are not playing as much of a factor. And these folks, if they get any carried interest, it's very little. That they are top heavy on cash, for the simple reason that they have to live on that cash, and they don't have money to invest. These jobs aren't designed that way. They're very competitive because good people always are attractive across VC, CVC, private equity. So these are the jobs you can see that CVC tends to pay a little bit less at the really at the top level, the 75th percentile. This is senior associate, right? But the 25th percentile is comparable and really close on the median levels as well. We always see this, that the 75th percentiles are where the top people are making, that's the more of the higher category. And then here is the senior for the different assets under management. So you can see for CVC, because not all VCs are created equal either, right? The more assets under management, the larger the management fees they have. They typically have more structure in terms of their roles. One person is not doing as many things that are really defined. And you can see here that at the 25th median and 75th percentile, this is the CVC over here. So it really does matter by assets under management. And this is good because if you have access to our data, you can toggle between CVC and VC. It's this two separate questions, but that's great because you yourself can compare and contrast. So that is the whole subscription piece of it, comes up all the time. And then we didn't give you a lot of information here on the carried interest CVC versus VC. I just wanted you to see that it's very little data here. So I'm going to stand down for a second to see if there's any other last questions, or maybe Sue and Jim. We've showed a lot of information here, and we didn't touch on a lot of things like the CVBD roles, but we came up with quite a bit of information. So I'm going to
put a plug in
together for us.
Yeah, I'm going to put a plug in for you, Jody, because none of this existed in a unified manner in the past. When I had to go and get information, I called Jody and I said, what do I do? How do I get this information? And it was all based on VC. And I said, no, I want CVC data. And she said, oh, well, I can tell you what I know about this and this and this person from her personal knowledge. And thank goodness over the years, and it's been, in 14, 15 years that she is just pulling this information.
About 9 years, the CVC.
Yeah.
Thank you. And you know what I did? I went over to DLA and said, okay, I need content for the questions. And that's what you all did. I mean, DLA has always been the partner in the CVC space. And really, Sue, to your credit, you're one of the few and the original people where CVC investing has become a real career track. And so that is why there are, and you helped, I think, the VC industry as well, because now there are defined career tracks on both sides. And the sheer fact that we can ask the questions about where they correlate and sync and where they don't, and that we have data to support it, really came from all of you, because CVC is a business that's here to stay. It's growing. People are making a real career out of it, and they're moving back and forth from CVC to VC. So yeah, Jim.
I was just going to say, I think that's 100% correct. And I'll also just say, I think it's interesting to see how, let's just say mid-level associates to senior associates that are in consulting arms go over into the CVC arm and then say, well, wait a second, I learned a lot here. Let me go back. There is definitely that flux between various different industries and things along those lines. So couldn't agree with you more. And I think that's going to continue. It's also a very interesting space, right? I mean, it's obviously you're learning something new every day. It's I'm jealous in many respects of what folks in the space get to do.
And
Yeah,
let me
it's a
just
great
say one
space.
other
Yeah.
thing, Jody, for the folks that are listening, and that is you are doing a real service to the corporations. And let me tell you why. And it took me a while to really understand that. Your perspective is a portfolio perspective. The operators in your company don't typically look at it as a portfolio. They tend to look at things by product or by business area. You get to look at across the board as a portfolio. That strategic thinking is so very, very helpful. So keep spreading it and feel like you're actually adding an incredible service, not only because you're up in front in technologies and business models, et cetera,
Right.
but frankly, that strategic portfolio view that you are taking is something that your corporations will really benefit from.
And keep participating. We're going to send out a link after this. Everything is anonymous. We know that several CVCs, and it's the same thing on the VC side, don't want you to participate. So you can participate individually. We don't publish a name of a participant list anymore because that became problematic. So all the data is in confidence. No individual name shared, no name shared, period. And really, you can see that your input is helping us to produce this data. So we're going to wind up. Thank you so much. We'll send out a recording. And for those of you that are here, if you have other questions, we're certainly glad to help. And Jim and Sue, could not do this without you. Thank you so much.
Thank you, Jody.
Good afternoon, everybody.